Oil majors, tobacco companies and miners are some of the biggest dividend payers on the FTSE. These firms have all been criticised from an ESG standpoint and often get branded as sin stocks. Despite the asset management industry attempting to be more ethically conscious, the likes of BP, British American Tobacco and Rio Tinto are common holdings in UK income funds. So is it possible to have a solid performing UK income portfolio without these sin stocks?
The market is quite polarised. If you look at the UK stock market, a lot of the income producers come from areas like energy, like tobacco, and therefore you can build an income portfolio without investing in those sectors, but it's more difficult. It's going to be more concentrated, and you'll have more specific, more sector risk and more stock-specific risk, which is harder to diversify.
I personally don't think you necessarily do, but it does touch upon two quite poignant aspects of the UK equity market. One is that clearly it is, or has historically been and continues to be, a good income generator as a market. But secondly is the fact that it has a reputation for being overweight sin stocks.
British American Tobacco currently offers a dividend yield of 7.9%, while Imperial Brands stands at 8.9%. This compares with the FTSE All-Shares yield of just under 3%. Both companies have seen their revenues rise over H1 from a transition into vaping products. But is this enough, considering the continued prevalence of cigarette smoking and the industry's poor history on marketing carcinogenic products?
We're seeing, for example, in the tobacco industry, less harmful products being developed. Nicotine is not actually that dangerous as a product. It's the cigarettes that are more dangerous. If you can have vaping or you can have less harmful nicotine products, you can transition the industry, you can transition the customers, and actually you can help them. So I think we're definitely believers in engaging with the businesses to improve what they're doing, to improve the safety profile of companies, but also to improve the lives of the farmers. The tobacco farming can be quite a dangerous activity, and we want to see the industry improve the lives of the farming communities, which is now working to do. Because of the pressure from investors, the industry is turning over and becoming more responsible. I think investors have to decide if they're comfortable investing in that sector, but we, as in what we're trying to do in our funds, is trying to understand the risks that there are to these companies because fewer and fewer people smoke each year.
What are your personal issues with tobacco stocks?
Well, we haven't owned a tobacco share for more than a decade. And I guess if you went back 10 years ago, we didn't used to call it ESG. We didn't own a tobacco company because they made products that killed people. They overcharged for them and kept putting prices up in an unsustainable way. The companies had an awful lot of leverage, which meant that they were quite dangerously financed, and they had a severe risk of litigation, and none of those have changed. So back to my point about trajectory of change, I don't think there is much in tobacco. Clearly there's a bit of new product, but are we going to be talking about vaping in 10 years' time in the same way as we were about rolled tobacco in the last 10 years? It still seems to be a product that's highly addictive, maybe to even younger cohorts of society. So to us, that doesn't really feel to be an area that we should necessarily be encouraging or supporting.
Never say never, but tobacco stocks have a very high hurdle to get over to become ESG friendly. And when I say high, I mean probably divesting or exiting the combustible business and becoming smoke-free. What you see with the tobacco sector is it is by far the biggest negative social value contributor in the index because of the obvious negatives that the tobacco sector has.
So if it's so negative, why invest in tobacco companies?
Well, you invest in tobacco companies because they are very resilient, defensive cash generators that are currently trading on very attractive valuations, and in the case of Imperial Brands, a stronger balance sheet than its peer in the UK, British American Tobacco. So I mean, you can get dividend yields in the high single digits from these companies, and because they are such addictive products, you have high visibility on those cash flows over time. And when we look at sustainability or ESG factors across our fund, we like to look at it on aggregate, particularly relative to the index. And one thing we take comfort from is that despite our holding in Imperial Tobacco, that on aggregate, on our internal proprietary systems, we score materially ahead of the FTSE All-Share Index because of a number of things we do own, perhaps in the healthcare sector, but also a number of the things we don't own elsewhere in the sin sectors.
suppose oil's really interesting because if you look at maybe the attitude of the US companies versus European ones, many of the US companies, I would suggest, are still in denial to some degree and are doing very little in the renewable space. Whereas I think the European names, and particularly led by BP, have been very proactive. Under new leadership, in terms of that pace of investment in renewables, they're going to be investing at least $5 billion per annum in solar and offshore wind in particular. And I think they have got skill sets which are very useful and applicable, particularly to offshore wind. Think about offshore wind has lots of similar characteristics to offshore oil and gas platforms, both in terms of construction and indeed managing them in sort of hostile weather environments. So I think, obviously it will take some time, but ultimately, we do need our energy companies to broaden and to become more diverse than they are. But at the same time, we also are going to need security of energy supply in the next 5 to 10 years as well. I mean, look at the events of the last week or so, all these worries about, shortages of gas and gas spikes just shows you the sort of danger of sort of moving too quickly away from the sort of old world, if you like, towards the new one.
If you really want to improve the environment and you want to get people transitioning to new fuels, we're going to need the energy majors. If we want to develop hydrogen at scale, and you need companies that can build the plants to manufacture that hydrogen, can distribute it around, can actually supply at petrol stations, at filling stations around the country, around the world, we need the energy companies. Companies do change over time. I mean, it wasn't that long ago that Unilever was involved in the whaling industry. No one says should you invest in Unilever because they used to be a whaling company.
Rio Tinto has been met with ESG controversy recently over environmental damage caused by its Paguna mine in Bougainville, 32 years after it fled the island as it descended into civil war. Mining firms also have a poor historic record on working conditions. But is investment in these firms a necessary evil, considering the increased need for raw materials like copper in electric vehicles and batteries?
We've been in a very elevated commodity price environment from mid-2020 through to broadly now, which has meant that the cash flows of these businesses have been phenomenal. And often mining companies have what we call mechanistic payout ratios, where they pay out a fixed percentage of their earnings in the form of dividends, because after the crisis that the mining companies had in the mid-2010s, they've repaired their balance sheets, which means that they can now return surplus cash to shareholders. And they've been doing that handsomely in dividends, both BHP Group, Rio Tinto and Anglo American. And to address the ESG point, it's another interesting one where clearly we've had particularly social and governance failings at Rio Tinto in the last 18 months after the Yukon Gorge disaster, which we've engaged quite heavily with the company on, and we're pleased to see that the actions they've put in place to change their actions and policies around their engagements with Aboriginal communities. But also, you can actually flip the ESG debate on its head with the mining companies, and you can say that they are arguably big facilitators of the energy transition, because what does the energy transition require? Well, it requires a lot of metal, it requires a lot of copper to electrify the grid, and Anglo American in particular have got some huge copper projects coming out over the next few years. Wind turbines, the majority of their raw materials are steel, which comes from iron ore, which is going to be produced by the likes of BHP Group and Rio Tinto, and a lot of the platinum group metals end up in things like car batteries and a lot of the infrastructure around electric vehicles and the electrification of grids.
You can't get your power back from an offshore wind farm back to land and up and down the country without using an awful lot of copper, or you can't get your Tesla car or equivalent to work without having copper and lithium and nickel in terms of the inside the car. But unfortunately, many of those metals are found in difficult political jurisdictions in the world. That's just the nature of it. So if you like, I guess I'd argue that to some degree mining is on sort of both ends of the seesaw, and you can't have one without the other. But the same issue, I think, is that if we can encourage these companies to produce, to focus more and more and produce more of those critical energy transition metals, and then maybe less of some of the old fossil fuels, particularly coal. And you'll know things like a company like Anglo American has recently divested its coal, spun out their coal business. Glencore are de-emphasising their coal business, and copper is a far bigger business for them than coal. Then again, these companies are, I wouldn't go so far as to say necessary evils, but without them, many of the positive attributes of the kind of energy transition that everyone is hoping to see just simply won't happen.